Want to invest in the stock market, but you don't know where to start. Maybe you don't even know what the stock market is. Then you came to the right video, because at the end of this video, you're going to understand what the stock market is, and you will have the ability to make your first investment if you choose to do so. I'm Lewis Thomas, this is the Frugal Student, and today I'm going to teach you what is the stock market and how you can make your first investment. So firstly, I want to take you through what is the stock market. The stock market is a mechanism, if you like. It's a market, it's a place where companies can sell bits of themselves in order to generate some money. Can sound a little bit complicated, but I'll give you some examples now. So you have probably heard about two kind of types of company, an LTD company and then a PLC company. LTD stands for limited liability and PLC is public limited company. Now the PLCs, these companies are the companies that we can buy shares in. So why, if you like, why can we buy shares in some companies but we can't buy shares in others? For example, you'll be able to buy shares in Next, Google, Apple, but you won't be able to buy shares in Mars, for example. The main reasons that companies list their shares on the stock market is to be able to generate money in order to grow their operations. So when you're buying a share, that money is going to the company and then they can invest in, maybe they want to buy a new factory, open some new stores. So that is the main reason why companies list on the stock market. And a new listing is called an IPO, an initial public offering. But we don't have to get too much into that yet. Now at the moment, you may be imagining just one giant pool of companies that we can buy shares in. So you're probably thinking stock market. But that's actually not quite the case. Within the stock market, you have different indexes. And indexes simply are specific lists that have been built up of stocks. Imagine if you just had one massive list of all the stocks in the world that you could buy shares in, you'd be lost. So we need a way to break these down. And what I'm going to do, I'm going to give you an overview of maybe the most important ones for you to know as investors. The first one, for British, we have the FTSE 100, or the FTSE 100 as it's more commonly known. And the FTSE 100 simply lists the 100 biggest companies in the UK. So in there you have companies such as Next, such as Marks and Spencer's, for example. And then you also have the FTSE 250. And all that does is extend the list by another 150 names. So you have the top 100 plus the other top 150. That then is the list of the 250 biggest companies in the UK. American investors, they have more, but I'm just going to give you an overview of two. You have the S&P 500, and then you have the NASDAQ. As you probably have guessed by now, the S&P 500 are the 500 biggest companies listed in the US, and the NASDAQ then is a collection of the tech stocks. So that's maybe more unusual or more specialized index, as we say. Before we get into making our first investment and how to make it, I want to go over very simply one of the biggest misconceptions of the stock market, and something that's very, very, very important for you to understand before you get investing. Now, I'm sure that you've seen these stock charts, stock graphs, and maybe you've seen them on films, on TVs or in newspapers or something, but quite simply all of these does is tell you the price of a stock at any given day. Now this price actually counterintuitively has very little to do with the company. Well, it kind of has something to do with the company, because if the company performs well, then really the stock price should go up, but that's not always the case. All this measures is the supply and demand for a stock. So let's go over a fake scenario that I've made for Frugal Student PLC. Now, you have on this y-axis here the measurement for the price of the stock. So all you can see here is that the stock was worth less here than here. So here we can assume that the stock maybe was a bit out of favor, people didn't like the stock, so they were selling. So you had lots of people trying to sell, not many people trying to buy, so the stock price goes lower to try and entice in buyers. When we hit here, we can see that maybe the prospects are looking better for the stock, or as is more accurate really, is the stock just gets more popular. So you have maybe less people wanting to sell now, so you have to offer more money in order to buy the stock, thus the stock price goes up. It's simply supply and demand. It's not linked to the stock price performance. It should be, but it isn't. I've seen stocks that perform dreadfully and just go up and up and up forever. I've seen stocks that perform very well and they go down. A lot of it's to do with mood, and the market can be irrational. Remember that. As we see here, you have the stock price increasing quite dramatically, which usually means there's a lot of hype, a lot of popularity around the stock, which means that if investors that are holding the stock are going to sell, they're going to want a higher price. Let me just emphasize this one last time. This is not always, or actually, unfortunately, is rarely linked to the actual underlying performance of the stock, which is very, very annoying and very confusing as an investor. But if you understand that, then things are going to go well for you in the stock market. Now, there are two main ways to get involved in the stock market. The first, which is the riskier way to get involved in the stock market, is through buying individual shares. Now, because of the way that the commission usually works when you're buying shares, if you're going to buy shares in a company, the minimum amount of money you're going to be looking to put in is probably around at least £500. Otherwise, it just isn't efficient. So if you want to buy individual shares in individual companies, the way you would do that is you would look maybe to buy shares in, let's say, Apple. So you would go through a broker, and we're going to talk about brokers later on in the video. You would go through a broker and you say, I want to buy shares in Apple. And you'd say, I want to buy 50 shares, you'd pay them the money, and then they'd give you 50 shares in a holding account. Works a bit like a bank account, and you would only have shares in Apple. You're then free to add other shares to your portfolio in this account. Maybe you want to add some Amazon, some Next, some Tesco, some Facebook, and you can build up this portfolio of shares. Of course, remember that those shares have to be PLCs, they have to be listed companies. You can't go around buying shares in private limited liability companies. Now, the second way to get involved in the stock market, which is a much safer way, is through funds. Now, you'd have seen that I put two arrows here, and that's because there are two different types of funds. The first type of fund is what we would call a managed fund, and the second type of fund you can have is a tracker fund. Now, there are more types of funds before people and maybe more experience start shouting at the screen, but for the purposes of this video, let's keep it simple. There are two main types of funds. Now, the first fund is a managed fund, and a managed fund is actually run by a person. They may have a team underneath them, but it would be run by a person. Now, he or she running the fund would make decisions what to buy, what to sell, when to buy, when to sell, and it would be down to their discretion. Now, they can't just do totally anything that they want because the funds are sorted into different categories, and they all have different aims, different objectives, and also different rules. So, for example, you could have maybe something called Asia Focus as one of the funds that I've heard of lately, and that would then look to buy shares in Asia. So of course the fund manager then can't go buy in, I don't know, FTSE 100 companies that aren't operating in Asia, because that's outside of the rules of the funds. There are other funds, other managed funds that will have rules about what size of companies you can own. You can have something called a small cap fund, which means that it only invests in smaller, more risky companies. So they can't just go around doing whatever they want. There are certain rules. You can find out about those rules in something called the fund prospectus. Now, by law, every fund has to have a prospectus, and every fund's prospectus has to tell you what the rules are, and also they have to have a safety rating or a risk rating for that fund, so you know exactly what you're getting into. Now, the pros of managed funds are, of course, that you have a professional taking care of things for you. They have a team of people, and it's not you making the decisions. It's professionals who do it for a living. The cons are that they're usually very expensive. You think how expensive is going to be to employ a team of people doing research, deciding what to buy, what to sell, and they usually charge very high fees. And that is why the vast majority of people, or the vast majority of conservative investors, believe that this type of fund is much, much better. Now, Warren Buffett is one of those people who believe tracker funds are much, much better. If you don't know who Warren Buffett is, I suggest you Google him. He's one of the greatest investors of all time, and he made a bet with a famous managed fund manager that tracker funds would outperform managed funds over time. What is a tracker fund then, and how do tracker funds operate? Whereas managed funds are managed by a person, tracker funds are usually managed by a machine or a robot. One tracker fund that I can think of off the top of my head now would be something like iShares S&P 500. And there is a robot, or a computer if you like, that is constantly working in the background and is rebalancing this portfolio as things go along. So let's say, for example, Apple is doing very, very well. It's becoming a larger component of the S&P 500. Then it's going to buy more Apple. On the other hand, you could have a company that's right at the bottom of the S&P 500 suddenly fall out. So their market cap, or the value of that company, gets lower, and then it's overtaken by a company outside of the S&P 500, and they swap. So it's a bit like football in the Premier League. One gets relegated, another one gets promoted. So what this robot, or what this computer then would do, is sell the one that's relegated, buy the one that's promoted. And it'll do this as time goes on. And the big, big, big benefit of that is that the fees are extremely low, meaning that your money will compound or will grow at a faster rate. Also, another thing that's important to understand here is that this has no emotion. It's not listening to the news, it's not listening to the doom and gloom stories, but also it's not listening to very, very overhyped stocks that are going to end up losing you a lot of money. So what this video is going to focus on is how to buy one of these tracker funds, but I'm also going to show you how to buy an individual share or individual company's stock as well. But I would very highly recommend against doing this. Not that I'm giving any type of financial advice here. I'm not qualified to do so, but I would think long and hard before investing in individual shares. So now we're going to move on. I'm going to tell you what broker we're going to use today. I'm not receiving any sponsorship, nothing like that. I'm not going to get a penny from this broker. I'm simply recommending it because it's easiest to use. So let's move on to the next bit. Next bit of the video, I'm going to want you to go onto a website called hl.co.uk. And HL is short for Hargreaves Lansdown, and they are what we call a broker. There are many, many brokers out there. Many actually cheaper than HL as well. HL is more on the expensive side. But if you're a new investor and you've never ever invested in the stock market before, then I very highly recommend that you go on hl.co.uk, simply because it's very nice in the way that it's laid out. It's very easy, it's very user friendly. A lot of their research is in terms that new investors may be able to better understand as well. So if you go onto hl.co.uk, they are a broker, and HL are the company that we're going to be using to buy our first stock, or hopefully better than that, buy our first fund, because the fund is going to be a lot safer for you starting out. So hl.co.uk, they are a broker. So quite simply, you put in an order through HL, and then they will buy that share for you on the stock exchange and charge you a commission. HL charges a commission of £11.95 for every stock that you want to buy. That's not per share, that's per transaction. So if you buy one share, it's going to cost you £11.95 in fees. If you buy 1,000 shares, it's going to cost you £11.95 in fees as well. If you buy funds on hl.co.uk, this is why, another reason why I'm recommending them, funds are going to be free, so you don't have to pay any upfront cost for funds, but you do have to pay a yearly management charge of 0.45%, as well as the charge for the fund as well. Every fund will have a different charge. Okay guys, so if you've put in hl.co.uk, this is the screen you're going to be greeted with. And I want you then to go on to our services. Of course, you should read these yourselves before you make any decision. I'm not qualified to give any financial advice whatsoever. I can only tell you what my experience has been. Now, if you can open a stocks and shares ISA, that would be, in my opinion, my non-professional opinion, the better option, because you will be sheltered then from any tax, for example, from capital gains or any dividends that you may receive in the account. For today's purposes, I'm just going to click on Funds and Share Account, so you can see it's the same sign-up process. But what you want to do is to read through these, make sure that these apply to you, read through all of the terms and conditions, make sure that you're happy with everything, and then start your Fund and Share Account or your ISA online. You fill out your details. Now, what you're going to want to do is to click this one, set up monthly payments. Now, monthly payments are the best way to invest because you can average up and average down along with bull markets, so the market going up and also market declines. If you want to invest in a fund, you can do it from £25 a month. So you can invest just £25 a month into a fund. If you're going to want to invest in a company, then that's going to cost you, you're going to have to put in a minimum of £100 every month to a company, although I would highly recommend, in my humble opinion, again, non-professional, that you go for the £25 a month setup direct debit. Now, you can see here it says investment choice, because that's the next bit, is investment choice. While I remember in account settings, it's going to ask you whether you want to set your account to accumulation or income. When it comes to receiving dividends, you can just say pay the dividends onto the account, just while I remember, because I'll probably forget. So investment choice is the next bit, and you're going to be greeted with the choice to invest in funds or shares. So you want to choose funds when it comes to that. So I'm going to be going on to a different screen now, just to show you the fund that is probably the again, my non-professional opinion would be one of the less risky funds for you to invest in. So you're going to want to look to invest in the UBS S&P 500 index. So this is one of those tracker funds that we were talking about earlier. And as you can see, the charge here is 0.09%, which is extremely low. But remember, Hargreaves Lansdown charge a fee of 0.45% on all of your holdings. So you're going to be paying that on top of the 0.09% charge here. So as you can see here, it'll break down the top holdings for you. And these are exactly weighted to what these are on the index. So 4% of the S&P 500 index is Apple, 3% is Microsoft. So this is tracking it as it goes along. And it reflects the market daily at 22:45. It'll update these to the new weightings. When I said earlier about the prospectus, it's called here the key investor information document. Prospectus, pretty much the same thing really. And it says about the risk and the charges, and it's all laid out there to you. So you should always read this before you make a decision to invest in the fund. So it would be an idea, if you'd like to set up your account today, that you go on UBS S&P 500 index, you choose to invest in that, and then congratulations on your first investment. That'll go in on the 10th of the month. I really hope this video has been of a great help to you. It took me a very, very long time to make, very late in the morning as well. So if you could subscribe to my channel, if you could like the video, it really, really would go a long way to helping me make more videos. Give me that boost, give me that motivation, and also a great following on YouTube. So congratulations on making your first investment, and hopefully you'll check back for more Frugal Student videos. In the meantime, you can check out my website, which is frugalstudent.co.uk. And you can see about me here, about my portfolio, what I'm holding. So you can give that a look as well. That'd be great. But for now, congratulations on your first investment.